I'd like to make one remark about where this all came from. I was asked by a student in November why we weren't talking about the financial crisis in our lectures. And this was a German student in the Diplom program, so someone who had been around for a while. And I felt very guilty, and I said, okay, well, let's try to organize something. And I asked a few colleagues who were working in the area, and a flood of response came. About 12 people asked. I think 11 said they'd do it. So we had this Ringvorlesung that's been going on since December, and it's actually quite successful. You never can give people enough. So some students came up to me and said, well, why are you giving your talk in German? So I said, okay, I'll give it in English, which is not a big deal unless nobody shows up. So I'm very happy that a lot of people showed up on a Friday. This is very nice to speak to students in my native language, and maybe the ideas will come through more clearly than they usually do when I'm speaking your language, or in German in particular. So this is part of the MEMS series. In some sense, they're sponsoring it. We're getting some help from other places as well. I'd like to thank Maggie, wherever she is, okay, for organizing this, and everybody else who's been involved. This is not just a translation of what I did in December, but it's actually an updating, because a lot has happened since then. A lot of very interesting things. I mean, a new president in the United States was elected, was sworn into office. We already knew that he was president in December, or would be president. And a lot has happened in the financial markets. So let me get to that quickly. I'm going to speak for about an hour. You're free to interject or interrupt me if you like. But remember, there's a champagne or a Sektempfang. Americans say champagne when they really should be saying Sekt in the back after this is over. So if you draw this out to 7:30, there may not be much Sekt left. so please, let's try to limit the thing maybe in total to about 7:15 with questions. But I'm happy to answer questions as long as you want, as long as I can answer them. So this is about the financial crisis, which is now an economic crisis. So this is how I'm going to organize my talk. I'm going to talk about this situation we're in. So if you've done the MEMS program, you're very lucky because you've had some economics, even if you're more interested in business. And if you're doing economics, you're even luckier because we're living in a very interesting time right now. A lot of interesting things are happening, things that have never happened before, literally. It's a bit scary. And I'm hoping to convey some of this apprehension, as well as some of this feeling that we do have the situation under control. At least we understand what's going on, and we'll be able to address it in a way that is much more intelligent than was the case in the 1930s. The last time something like this happened was in the 1930s. So most of your grandparents weren't even very active back then. Your parents may not have even been born back then. Think about it. And people always make remarks that politicians and policymakers forget, they die, and they forget to tell the next generation what happened. And a lot of the things that led up to this crisis are exactly the things that led up to the crisis in 1929, 1930, and the depression that followed in the United States and the rest of the world in the 1930s. So I'm going to talk about the crisis and its origins briefly. I'm going to talk about the consequences for my country, and I just came back from the United States. I was there for 2 weeks and was able to get a fairly good update on what people are thinking about. And people are extremely worried, although we have a president who exudes confidence, which is nice. I'm going to talk about two conditions that I think are very, very important for the United States economy and thus for the world economy to come back. Okay, so I'm not going to say that the world is going to be in a depression, but unless two conditions are fulfilled, the recession may drag out much longer than traditionally recessions do. People like me look at recessions and you can measure how long they last, and there are very scientific ways of defining what a recession is, and most people say that recessions last 3 to 4 quarters, and there's a standard deviation on that of maybe 2 quarters. So some recessions are longer, and some recessions are rather short. Some are so short that people don't even call them a recession anymore. So there's a dispute in the United States about the length of the 1980 recession, for example. But there are also very long recessions, and the Japanese example can tell us that sometimes recessions last a decade. Long time. It's even, you don't even call it a recession anymore, you call it a slump. And then I'm going to talk about the policies of the Obama administration, which I, to some extent, support, but to some extent also would like to criticize, because I think people who are advising the president are linked to the problem. Okay, so I'm going to be saying something a bit critical, especially since I'm in Germany, and nobody from the American side will ever pick this up except for my friend David from college, who's here visiting, and he's a doctor, so he doesn't know anything about economics anyway. So, and if I'm talking too fast, if my jokes are going by too fast, just tell me to slow down. Okay. I do think that some of the policies of the Obama administration are absolutely necessary. Are absolutely necessary, and I think some of them may actually be a problem. And we should talk about that if I have time at the end of my talk. This crisis is a problem. Don't let some of my colleagues in Germany tell you that this is not a crisis. Okay, I know one economist personally, whom I won't mention by name, actually said, "Ich habe keine Krise gesehen. Ich sehe noch keine Krise." Okay, there are a lot of people who don't believe that there's an economic crisis because Germany hasn't really felt it yet. But I think if you read the papers, you see that it's already happening. And Europe is a bit divorced from the United States, but there is a global economic situation. And the drop in demand in the United States has already spilled over to the European situation. And we'll just try to document that. Let me try to give you an idea of how big this problem is. So to quantify, in September of 2008, the IMF, the International Monetary Fund, all of you know what that is, did an estimate of global credit losses. So the estimate on bank credit losses around the world of about 1.3 trillion US dollars. A trillion is a million. It's a lot. Okay, it's in German eine Billion. And that's a large number. And to get an idea of how large that is, we could divide into it the size of the world economy measured as GDP per capita in US dollars. Okay? So the IMF says that's about 65 trillion US dollars, including Lesotho, Burkina Faso, Canada, all the countries put together. We know this is a US problem, a UK problem, but now it's a German problem because a lot of Landesbanken have gotten involved, and this is already a year old, right? This is old information. Okay? But already, you could say, well, that's only 2% of the world GDP. We can get over that. That's just a little hiccup. Not a big deal. I'm talking about the write-down in loans that had already been visible and announced in the United States and were identifiable by the International Monetary Fund and all the other people who are holding this U.S. debt, these U.S. mortgages, which I'll talk about in a second. Just a few months later, Rubini and Associates, very prestigious Cassandra of the past 2 years, Nouriel Rubini, with whom I went to graduate school, announced that the losses in credit, derivative, and equity investments just in the United States are now pushing $4 trillion. Now, I don't know if you know how big the U.S. economy is. The U.S. economy is a $14 trillion economy. So the losses on these debts now represent a big chunk of the United States GDP, and the U.S. GDP is where a lot of the adjustment is going to have to happen. Okay, so we're talking about a large problem. The stock markets, as you know from my course and other courses, look ahead and anticipate the consequences of things that were happening already in 2007. And in the last year, we've seen losses in the equity markets on the order of 40 to 50%. This is not just bank stocks. If you were unlucky to own a bank stock, you'll probably have an equity loss of 90% or even more. Okay, this is an average of all the stocks in an industrial economy. The Dow for the US, the DAX for Germany, or the Euro stocks for the European large companies. Okay, so this is a large drop. We don't see this very often. The last time we saw it was maybe 30 years ago, and the last time we saw it really like this was in 1929, 1930. Okay, so we're talking about big numbers now. Big numbers, which have consequences not just for the financial economy. It is a shock to the financial economy, but it's also a shock to the real economy. Don't be fooled by those who say this is just a problem of Wall Street, because Wall Street performs services for us. It's the banks that we criticize, especially in the German press, actually do a great service as well as perform a lot of speculation. They also take your money and manage it. They create loans. They create the money supply that you use. Remember that. I mean, those of you who've taken my course know this. Makro 1, right? The basic banking, and I'll talk about that later. So the balance sheet of the banking system is something to which we're all hostage. If the banking system is in trouble, we may not like the bankers, but we're in trouble too. And don't forget that. So when you go vote for somebody who wants to nationalize the banks, be aware what that means. Okay? You cannot get rid of banks. Banks perform essential services. They perform other services which we can discuss. Am I speaking too fast? No. You all look shell-shocked. My German lectures are slower. So the tsunami of a financial crisis is a tsunami because you can see it coming. If you remember those films from Thailand, those poor people on the beach watching this wave come in, it was at least 20 minutes before the wave actually hit, so they could actually run away. But a lot of them were just like, yeah, what do I do now? You know, yeah, obviously you run like hell. You just get out of there. But some people really wanted to see if it was that big. It reminds me of some politicians in various countries. Okay, financial crises do lead crises in the real economy. You can see it in the Great Depression. You can see it in the dot-com crisis, which resulted in a crash in 2001, and it was followed by a recession in 2001, 2002. It's pretty predictable, if not with perfect precision, because economics is not a precise science like physics. So we're looking at a serious crisis. I'm not sure if our policymakers understand this, but if good policymakers make good policy, we might be able to avoid the consequences of the Great Depression of the 1930s. So to convey some optimism, we might be able to get our act in gear. It's not too late. And fortunately, the new president has actually taken a lot of, the new president of the United States, which is not the world, by the way, by any means. And the U.S. is becoming smaller and smaller in this global play of economic forces. So you really can't just blame the United States for everything, but of course you can blame it for a lot. And I do think it's going to get worse before it gets better. That's my own personal forecast, based on a bunch of things that we can talk about in the discussion afterwards. So let's talk about the origins of this situation. This is a classic situation where the sum of the parts is smaller than the totality of those parts acting together at the same time. You cannot just blame one component of the things I'm going to cite. I'm going to cite three ingredients that I consider to be absolutely inherent to this financial crisis, but also to the financial crisis in 1929, 1930. If you pay close attention, you'll see remarkable similarities. Okay? You take one of those ingredients out, you won't have 1/3 less of a crisis. You might have no crisis at all. But it's the confluence of several factors at the same time is what makes this thing roll. And I'm going to make a pitch for a book that I didn't write, but one of my professors at Harvard did write in 1993. And this book predicted exactly what's happening now, because what's happening now is what happened in 1637 with the tulips. It happened in the 1700s with John Law and the South Sea Bubble. It happened in 1929 in the Great Crash. And it happened in the dot-com bubble. It's basically an overextension of leverage and liquidity leading to the run-up in some sort of central price of some asset that people are interested in buying, and no one wants to face the truth that the fundamentals don't support the long-run development. Okay, so keep that in mind. The first contributing factor is that this did come from a single country. There's no question about this. So I'm an American. I would not like to admit this in public, but I'm going to admit it. And I'm going to have probably some questions from some half-Americans out there who will question this. I'm not talking about you, by the way. The source of this crisis was the United States. The U.S. is the source of a lot of interesting stuff. A lot of great inventions of the past 150 years come from the United States. Not everything, okay, but a lot of interesting inventions do come from the United States because America is driven by innovation, the desire to innovate, the desire to get rich. And getting rich in the financial markets has some consequences for other people who are innocent bystanders. Collateral damage, we can call it. Collateral damage. If you invent the light bulb, Thomas Edison, and he worked for years to get the right filament, to get it to glow in the dark. He didn't hurt anybody for all the failures he had. You know, he failed many, many times. He tried every filament, sheep hair, human hair, wire, and finally got something that glowed in the dark. right? Well, the failures didn't hurt anybody, but the failures of this crisis are going to be pretty painful. This is due to a speculative boom in the real estate market. So I'm not talking about gold, I'm not talking about the dot-com, that was a different crisis. I'm not talking about cows or oil, I'm talking about real estate. And we're talking about real estate in particular parts of the United States. Where I come from, the price of real estate went down over the past 10 years. But in California, in certain parts of California, and Las Vegas, in Florida, prices went up by 300 to 400%. Okay? During this period, people went crazy. Collective madness, as John Kenneth Galbraith calls it. Okay? The rest of you guys out there are not without guilt. The rest of the world financed this madness. People looked at America and saw this happening and didn't say, no, don't invest there, that's a bad idea. They said, it's got to be right, it's coming from the US. So they financed the biggest run-up of the US current account deficit in peacetime that had ever been observed. So the US boom was not just financed by Americans, it was financed by foreigners. It was financed by Landesbanken in Germany, by a lot of other private banks, the Swiss, and of course the British. So what are these ingredients? I promised you 3 things that you can write down and tell your grandmother about, okay? The first one is loose monetary policy. The Federal Reserve System is the central bank of the United States. And during the period after 2001, actually just after 9/11, which was an exogenous event, unpredictable, in my eyes, the biggest surprise of the past 20 years, this led to the Fed, the Federal Reserve, providing liquidity to the system, ostensibly to support the recovery of US bond and equity markets, which were threatened because of the confidence. I mean, the World Trade Center housed some of the most important banking and bond businesses in the country, right? Some of the big dealers just went up in smoke, literally, with that attack. And to stop the ripple effect, which was perfectly normal, the Federal Reserve System lowered interest rates systematically, and as you can see, they lowered them to under 1%. This is the rate at which banks borrow in the interbank market. The US Federal Reserve does not extend credit to banks directly, but it does open market operations as much as it needs to get the interbank market rate where it wants to have it. That's not the same as the European Central Bank. It's different, but the outcome is the same. Okay? These are like purchases of treasury securities and the like. So during this period, it was very, very profitable for any idiot to go borrow money from the interbank market and invest it in something. You could invest it in government bonds and you could make a profit. Okay, so this is like asking for trouble. A situation like this is asking for trouble. But the bond market was not the problem in the United States. As you can see, bond yields were actually fairly steady over this period. People were going somewhere else with their money. They were going into real estate. But this is an absolute and essential ingredient to a financial crisis. You've got to have this increase in available liquidity to support the purchases of the underlying asset. Okay, it's absolutely essential in my view. The second ingredient was that Americans like to own their own houses. And how do you buy a house? A house is a huge expenditure. It represents several years, if not decades, of people's income. How do you do that? You go to the bank. The bank gives you money. The bank actually cuts the check that pays for the house. And you have to pay the bank. That's called a mortgage. I don't have to tell you that. But it's very interesting to look across countries. Different people have different proclivities to live in their own houses. Americans like to live in their own house. Traditionally, 2/3 of Americans live in their own houses, their own 4 walls. In Germany, the number is under 40%, under 50%. It's risen a little bit over time. But America, the number was more like 60% 10 to 15 years ago. And at the height of the crisis, it was pushing 2/3. So during that period, there was a concerted effort on the part of politicians. One of my favorite presidents of all time, Mr. Clinton, you may be surprised. I like the guy, actually met him. Shook his hand. Mr. Clinton actually did this. Mr. Clinton, in his watch, actually increased the availability of mortgages to poor people. Nothing against poor people, but if you give mortgages to people who can't pay them back, you're asking for trouble. How do you get a bank, a conservative banker, like my Uncle Don? I know I've told you about my Uncle Don. Does anybody remember the story of my Uncle Don? My Uncle Don is a banker in West Texas, and he lends money to cotton farmers and cow ranchers, or whatever they call them. And he says, the way you do banking is you look someone in the eye and you can see if they're a scoundrel or not. You can actually look at them. 5 minutes, a good banker can tell whether this guy is a jerk or he's trying to rip you off. Okay? And a lot of lending in the United States and around the world is not based on collateral. It's based on trust. Okay? Mortgages should not be based on trust. We're talking big, big items. So how does it work in America? Well, it turns out in America, if you're unlucky and you lose your job under the status quo, you can just return the keys to the bank. The bank has to take care of the mess. Now that's a good system if you only lend to good risks. But if the market goes down big time, a lot of people are returning their keys to the bank, and the bank doesn't know what to do with a house that's empty. It has to try to sell it. Okay? So that's the fundamental problem. During the 1990s, and the Bush administration actually increased the availability of these mortgages, these so-called subprime mortgages to poor people, which is, again, nothing wrong with that. I would prefer giving the money to the poor people and letting them decide whether they want to have their own house or not. But by subsidizing it, you're creating a distortion in the market. Okay, and we know what distortions in the market do. Then we have big agents getting involved. Okay, Freddie Mae and Fannie Mac. Freddie Mac and Fannie Mae getting involved. These two people out there, these federally chartered but not federal institutions, actively refinancing mortgages by banks. Okay, what does that mean, refinancing? It means lending money to the banks. And towards the end of the story, that Fannie Mae and Freddie Mac are actually buying the mortgages and holding them on their own books, or even issuing securities based on these. Okay, so-called securitization. Talk about that in a second. Loose regulation of the mortgage industry. In Germany, if you want to buy a house, you usually have to put up a lot of cash. Even now, it's about 25% to 30% of the house purchase price. No wonder Germans don't own their own houses. Think about it. Okay, it's very, very expensive. So a lot of people, that's why the Germans are so into Bausparpläne. Right? This means you sort of force yourself to save for 15 years of your life, and you get this big chunk of money, and then you can buy your apartment. It's kind of like forced saving. Okay? Well, a lot of people look at mortgages like forced saving. Okay? But the problem is you really have to pay them back. And in Germany, if you default on a bank loan for a house, you don't just lose the house, you lose the ability to ever step into a bank again. You pay the ultimate price. And in Germany, that hurts because banks are important. Okay? In America, regulations were very loose. This is partly the fault of not just of President Clinton, but also President Reagan. There's this general tendency in America to deregulate, which has its advantages, but it also has disadvantages, which means you basically don't have to step up to the plate for the quality of the mortgage you've originated. And I'll tell you why in just a second. And there was fraud going on. To understand why this is a problem, when you originate a mortgage, if you're a rich person and you're lending to some person who can't pay it back, that's your problem. Okay, but what was happening was that banks were lending to people and then selling those loans, passing them on without any sort of liability. The lack of due diligence, as they would say in the financial world. Okay, so that leads me to the third thing. The innovations in finance that made this happen. This happened for a reason. Banks were not traditionally allowed to do this. Banks normally held the mortgage on the asset side of their balance sheet. So on the liability side, you got the loan, the mortgage, and you get the income from that. You got some net worth. On the asset side, you've got the mortgage. Okay, that's a normal balance sheet in the 1970s. Okay, in the 1980s and 90s, a lot of banks said, well, hey, we can do more lending, get more service income by just selling those mortgages to somebody, getting that money for that, and financing the mortgage that way, and then we can just finance some more mortgages. In fact, all we care about, in a sense, is just the service income I can generate because I'm collecting the money from the mortgage borrower and passing it on to the ultimate lender. so-called servicing function. And normally in a bank, those are combined. Okay, but the innovation in the United States was to securitize. Okay, so the bank takes these mortgages, and this is a very smart idea, believe it or not. I know a lot of you are trained now to foam at the mouth when you hear the word securitization, Verbriefung. Yeah, it sounds terrible. I go, this is a bad American idea. It's not. It's actually a very clever idea if done properly, because it means basically trying to diversify away certain types of risk. I come from a city where oil is very important, and during the 1970s, a lot of people became very rich, and real estate values rose very much in Louisiana, northern Louisiana, relative to the rest of the world, relative to New York even. Okay, this is a fairly normal thing to happen in a large country. It doesn't make sense for a bank taking deposits in Shreveport, Louisiana, to be investing all its money in the oil industry, because once the price of oil goes down again, the ability of Louisianans to pay back their mortgages may be attenuated, and the value of the mortgages will go down. It makes sense to diversify. So the innovation of the 1990s and the 2000 decade was to sell the mortgages to some other agent who would mix them, pool them, slice them into tranches, and maybe even make the tranches of varying risk. So if there's default, the worst tranche would not be paid off, but the best tranche would be paid off. Okay, this is called innovative securitization. Okay, there's nothing wrong with this, as long as the investor, and that means the Landesbank in Germany that was involved. There were like several of them now, but IKB, for example, back then they said they saw this AAA rating and said this is a great deal, and they didn't ask enough questions. They were really under a lot of pressure by German politicians to make lots of money, because they had to, because the EU asked them to give up, to forsake their government guarantee. Okay, so in other words, the Landesbanken had to make a profit, and it didn't seem profitable to lend money to local businesses. No, let's go to the United States and make a quick buck there. Okay? And then you have this business I talked about before. So all these things come together and cause, in their totality, a problem that's much larger than the sum of the parts. Okay. Then it gets even more complicated. Many of you are finance persons, you know more about this than I do, but new financial products were developed which made it even more interesting to invest in these instruments, because we could get rid of the risk. We could diversify our risk away, and we could also, if there's anything left over, we could buy some insurance against it. So so-called derivatives, the market for derivatives, which is, again, something we don't want to abolish. I'm by no means in favor of getting rid of this, but I think it's important to know what we're getting into, especially since insurance companies, the largest insurance company in the world, AIG, was involved in creating derivatives that paid off when certain types of debt didn't pay. Okay, so what's called a credit default swap. And these were traded for some time, and now they're very difficult to trade because no one wants to touch them, but they can be quite speculatively and interesting. There's a reason to have them, especially when you're owning Fannie Mae and Freddie Mac securities. So I don't know if you caught this, but while I was in the United States, there was quite a discussion about the fact that AIG's bailout was actually being paid not to Americans, but to Germans, to Swiss, to British banks. Okay, that's because those banks were clever enough to load up on these derivatives, which paid in the event that a lot of Americans stopped paying their mortgages. And because of the recession, a lot of Americans are not paying their mortgages. It's estimated that 20% of Americans live in houses that have negative equity, in the sense of balancing the value of the house against the value of the mortgage in nominal terms. And some insurance companies, some so-called monoline insurers, were actually involved in this in a more explicit way, which is interesting because Merrill Lynch was actually owning one of these companies and buying bond insurance from it. So it's an amazing situation. It's exactly what is not supposed to happen. You're not supposed to have an increase in risk, in global or non-diversifiable risk, because of these instruments. What happened is that these instruments actually created systemic risk. It made it difficult to let any bank go. And we saw the consequences of Lehman Brothers, because Lehman Brothers was heavily involved in this market. And to me, it seems a capricious decision to let Lehman Brothers go and bail out AIG and bail out Goldman Sachs and the others, because all of these banks are hanging together. Some were more and some were less involved. But in any case, the global risk structure of the markets were changing. Okay, so we have a summary. Loose monetary policy. The boom created capital gains. People sitting in their houses suddenly saw their houses had doubled in value. Now, if you're smart, you think about why this happened. But if you're hungry for that boat or for a quick buck, you take that equity and you go and borrow some more money and buy another piece of real estate. And that's exactly what happened in America. During the early 2000s, Americans started getting hungry for Florida, Las Vegas, Southern Californian real estate. Okay, so it became quite obvious you could go out and get a second or third mortgage on your house, especially if you lived in California, where the house that you're living in is so expensive, and you could use that for equity for further borrowing. It's a classic leverage boom. The problem, as I said before, is that while this was happening, Americans were consuming more and importing more from the rest of the world. The Europeans and the Japanese and the Chinese were lending to America, especially the Chinese, and they were using the attractiveness of these assets, these instruments, as a justification for doing so. No one thinks the Americans are going to default on their debt. But this underlying risk is very, very underestimated. So I'm going to give you the first little technical bit before I put you all to sleep. Finance 101. You've all seen this picture before. Okay? And if you haven't, I'll explain it to you. Okay? You don't get anything in life for free. There's a trade-off between risk and return. Okay? The more return you want, the more risk you're going to have to accept as an investor. This is a fact of life. Why? Because people don't like risk. And if something is risky, they're not going to want to buy it. The price is going to go down until it's attractive enough, then people will buy it. But at that low price, the rate of return that's expected to accrue will be lower than it would be for a riskless treasury security. Okay, you get that? So a guy named Markowitz a long time ago figured out that this is, so to speak, the efficient envelope of possible rates of return consistent with risk levels that are arbitrarily chosen. So if you want to take a lot of risk, there's a way to bear that, but you're going to ask for a very large rate of return. The markets are going to give that to you. It's a linear combination. It's the square root of the variance of the portfolio with minimum variance. Okay? This is called the Markowitz frontier. Now this teaches us basically that the whole world, or the United States, somebody has to hold the market portfolio. Somebody has to accept this level of aggregate risk. But individuals might be fooled into thinking they can get away with murder, okay? Maybe getting 25, 30% rate of return year in and out. And the lesson of Sharpe is that you can't do that unless you're borrowing money, because the markets are efficient. Okay? So this so-called Sharpe line is giving us the possible trade-offs if we're going to balance this market portfolio with the riskless rate that the government's willing to pay on its debt. Okay? So the only way you can get up there, Mr. Ackermann, CEO of the Deutsche Bank, the only way you can get up there is to take on a lot of risk. Now during the 2000 decade, these bankers were telling their stockholders, we got to make 20% rate of return on equity. Okay, but this is not possible over a longer term. This means that he was asking his shareholders to accept a lot more risk than he was telling them about. This risk was investing in these types of assets. Some of these assets were being put offshore, literally off the balance sheet, and were not even known to some investors, but those who knew what was going on knew that there was some risk involved. Okay. The bubble burst in 2000. I was in America, in Florida in 2007, and I saw the real estate signs for sale. I went to a place in Florida and saw literally streets full of for sale signs. No one was talking about a financial crisis, but the people who were investing in the real estate knew. They knew what was going on. The gravy train was over. So they're all, like if I say fire, we all rush to the door. Very few people are going to make it, even if there's not a fire. Okay? But those guys were rushing to the door. So already in mid-2007, prices of the prime real estate were coming down. This led to the so-called subprime crisis because the marginal loans became questionable, and the property values that further declined because of the forced sales by banks. So we have this natural deflation process, and of course the failure of major players caused even more concern and speculation in the negative direction. So we had a situation where people like Jim Cramer, who many of you don't know who that is, but he's a famous American who comes on TV every night and has this program called Mad Money, and he tells you how to make money. And back then the idea was you sell these banks short. You sell a bank short. Okay? Now, if Jim Cramer, he's not allowed to say that on TV. It's against the law probably to say that a bank is about to fail, but you can certainly hint at it. Okay? And a lot of this volatility is certainly due to this type of activity. But now the crisis has hit the real economy. It's a real economic crisis now. And why is that? This is not this is not sort of a tempest in a teapot. This is a serious problem for all of us because the banks were involved, and the banks provide the medium of exchange for our economy. Central bank, but also the commercial banks. All of you have a bank account somewhere, maybe at the Sparkasse. It's probably more likely to be there than at the Deutsche Bank or the Commerzbank. But no matter where it is, those banks provide a service. They provide us with the means of payment. And once that means of payment slows down, then the economy starts to suffer because you can't finance forward expenditures. You can't pay your workers in advance by getting credit. So the biggest the U.S. faced this, of course, early on, already in the middle of 2008. The recession in the United States had already begun before this happened, and some would say even in spite of that, but by the fourth quarter, we were looking at a real annualized rate of growth of negative 6%. This is a serious drop that hasn't been seen since the early 1980s, if not before. We will see what the first quarter of 2009 is in store for us. The most important thing for me is that consumption is falling. Okay, so real consumption expenditures, Americans are actually cutting back. They're not buying that boat anymore. There was a story in the New York Times about abandoned boats in Florida. So people are actually, it's too expensive to maintain these boats. They can't even afford to pay the dock fees. They just leave them. And there's no law against leaving your boat somewhere. Maybe there's a law against going to pick it up when you get money again. But in some case, this is a bad sign. Consumption is falling at a rate of about 3 to 4% per annum if you annualize it. This also means Americans are saving. So the savings rate in America has gone from 0 to something like 5%. This is also unprecedented. We have not seen this before in living memory. Investment has declined by 21%. And investment is volatile. You know that from business cycle theory. You've taken my course. Some of you have taken it. When we see this, we know there's a recession. But this type of sudden drop in a quarter is quite large. And it's mostly coming from domestic demand, but it's also coming from import demand. So foreigners are buying less American stuff. Mexicans are buying less American stuff. Canadians are buying less U.S. American stuff. And inflation is falling. So these are telltale signs of a recession, and a deep one at that. Okay, so here's the summary. The world is in a recession now. Unemployment in America has already reached 9%. The so-called U6 measure is well over 12%. So Americans are suffering. You may not quite see that. It's very difficult to see it unless you've been there. But the recession is continuing, and the labor market is a lagging indicator. So we expect to see things get worse in the labor market before they actually get better. So the obvious question to ask in my last 15 minutes or 20 minutes is, how do we get out of this mess? So here are my two conditions. I think real estate prices have to stop falling, and they are still falling. Why is that? That's because those real estate assets are backing the loans that the banks made in the past 10 years, some of which are actually bad. And when those loans are bad, that means that the banks cannot recover the value of the loan when they foreclose. And the likelihood of that happening is quite high now in many regions. Interestingly, in America, the most striking development has been the development or the renaissance of regional banks. Again, I have to keep talking about my hometown just to keep you awake right now, but in Shreveport there's been a large increase in local banking. One of my classmates from high school has his own bank. So he's looking in your eyes to see if you're a credible borrower or not. It's amazing. I saw the guy on TV. He started his own bank. Now, you can't do that in Germany. It's hard in Germany to start your own bank. There's lots of regulation. But for that to happen means that people don't want to go to the other banks. So the growth of deposits has stopped. Credit by the big banks in America has stopped. Chase, these are really huge banks. They've become bigger because they've taken over investment banks. Bank of America took over Merrill Lynch, JP Morgan. All these banks have taken over investment banks to give them the shelter of the FDIC bank insurance system. So these large banks have been called by some, including Paul Krugman, zombie banks, because they're not doing anything. They're not lending. They're not getting many deposits. They've got their hand out for a handout from the government, but they're not really actively bringing the economy around, because one of the most important things for the economy to turn around is to get credit rolling again. This is why the Obama administration is trying very hard to do a stress test on these zombies to see if they're dead or whether they're just half moribund, or maybe breaking them up is a good idea. This is serious. And that's why in the next few weeks we're going to get some very interesting information. Some banks are doing well, like the Wells Fargo Bank had a very nice, of course they try to inflate their numbers the best they can, but some you can't because things are so bad. Okay? Real estate prices have to bottom because the bad toxic assets that they're holding will get worse as real estate prices in nominal terms continue to fall. The other thing that has to happen is that trust has to be restored in our financial system. You have to be willing, as another banker, not necessarily as a depositor, but as a banker, to lend money to other banks. And right now, people are scared. People in banking, like my friend Walter Lamb, who was on TV the other day, he doesn't want to lend money to Citibank. He's not going to put his excess reserves in a Citibank account, a correspondent account. I don't think he's doing that. He's probably got something at Wells Fargo, but this is what bankers think about. Banking is about trust, and if trust doesn't get restored, we're going to have problems. Let's talk about real estate prices. I want to convince you that this is extraordinary, what we've seen in the past 20 years. Okay? Now, some of you were at my lecture last time. Who was at my lecture last time? Okay, just a few people. Okay, you've seen part of this, but I've actually updated it. Okay? This is the Case-Shiller Index of house prices adjusted for inflation. So if you took the American house, the standardized American house, again, standardization is an issue, but Robert Shiller is a very smart man, and his colleague Case is no idiot either. They worked very hard to adjust for these factors, especially inflation. If you had bought a house a standardized house in 1890 and paid $100 for it, $100 or whatever, you can see what's happened to that price. Okay, so after World War I, there was a big drop. Americans were in trouble because of the influx of people coming back after the war, and there was a dip in the economic activity after that. Prices were actually below that average of the 1890s. Up until the Great Depression was over with World War II, and all those GIs came back, those American soldiers came back and got access to loans to buy houses. In the 70s and the 80s, there were slight blips in this price index. This is an average of house prices in 20 major metropolitan areas, again, adjusted for inflation, divided by the price index. Okay, so this is not a rate of change, this is the level. So you can see American house prices look pretty stable. If you were an econometrician, you would call that a stationary time series, maybe fractional stationary, but it's certainly stationary. It looks like it's crossing the mean a few times. Okay, I think most of you would agree with that. Although Professor Lutkepohl didn't agree with me when I said that to him. You don't know Lutkepohl. This is, I wouldn't be showing this unless there was something really shocking at the end. So this is up until 1995, and this is the Case-Shiller Index after that. Okay? So this is the average price on a standardized house in these 20 metropolitan areas, which include Shreveport, Louisiana. Actually, it does include Shreveport, but it includes places like Dallas, Texas, which had fairly limited boom potential. And then, of course, Las Vegas, which was up to 400. Okay? So this is a huge run-up. This looks like tulips in 1637. When the Dutch people got really mad about tulips, and then they lost all their money. It's like the great the great boom in the 1920s when people were borrowing money to buy stocks. That was the big innovation. They didn't have derivatives back then. They had margin lending. So you could go to your bank and borrow money and invest it in stocks. Okay? And of course, that was probably not a bad idea if it's done responsibly, but it wasn't done responsibly. So here's what's happened since then. This is the update. Okay, so we're now at about 150 in January 2009. Okay, if you believe what I said before about stationarity, we still have a ways to go. There's still a lot of toxic in those toxic assets. Somebody's holding them. Maybe some Irish offshore investment vehicle that's owned by your Landesbank. It could be a zombie American bank. It could be some private individual, but it's out there, no question about it. And a lot of people here are sitting on very expensive houses that are no longer expensive. So that's the problem. And I don't see the second derivative changing. I think this, if anything, it could actually be increasing. Okay, things might be getting worse in absolute terms before they get better. This is this is evidence for that. This is the foreclosure rate up until 2007 on the subprime rate. So when you have a default rate of 26%, okay, allegedly it's still rising, but at a falling rate. This is fortunately a small fraction of Americans. Okay, this is the big chunk, but you can see that the prime default rate has risen to a level that it hasn't seen in the past 15 years. So, you know, people are defaulting on their loans. We hear about these places in California where people live in tents because they can't live in their houses anymore. Foreclosures are apparently increasing in the United States. These foreclosed houses are not used by the banks to live in, they're sold. And that, of course, depresses prices further. Ironically, we want that to happen. A good economist wants that to happen. The correction has to occur. And it's better to have it happen soon as opposed to what happened in Japan, where it took 10 years for it to happen. The Japanese had a very similar situation. Okay, but they didn't deal with it the way an economist, financial economist might like to happen. They tried to paper it over by doing lots more lending to the bank and sort of covering it up and, you know, creating zombies. So this is an issue. House prices are important because they determine the value of the underlying asset, and that's important for the valuation of the asset. So no matter how you slice it or dice it, it's still toxic.